everyone, today is Tuesday, December 23rd, 2025. Hope everyone is doing well mentally and physically. Welcome to another episode of Tax and Accounting Ride Along, brought to you by Sans Virtual Enterprise, LLC, your go-to dose of straight-talking tax and accounting insights for small businesses and the everyday taxpayer in the general public. As we enter this joyful and reflective season of the year, I extend my sincerest gratitude, thanks and love to everyone out there listening and who have listened and supported me along the Sans Virtual Enterprise LLC journey. Seasoned greetings and a Merry Christmas to all of you and your family. Make it unforgettable, make new memories, and always live, laugh, and love the life you live. And all the best for an even more blessed, happier, and brighter New Year 2026 ahead. YOLO. Okay, today we are going to be diving into NOL, net operating losses, and strategically using those losses to your benefit. With the year winding down, these insights couldn't come at a better time for making strategic business moves. So without much further ado, let's crank it up and get straight to it.
Okay, let's get into it. Today, we're doing a deep dive into something that sounds a little dry, but is actually critical. Net operating losses, or NOLs.
Right. And really, the goal here is to unpack how businesses use them for tax benefits, because the whole strategy has been turned on its head recently.
Exactly. We're going from, immediate gratification to a long-term, much more complicated game.
So just to level set, an NOL is pretty simple at its core. It's when your allowable tax deductions are more than your taxable income for the year.
So you owe no income tax, which is great.
It is, but that's not the real power.
Yeah.
The real power is that the loss doesn't just disappear. It gets banked, and it basically becomes an asset you can use against profits in other years.
And historically, the main way you did that was with the carryback. I always thought of it like a sort of tax time machine.
That's a good way to put it. You could take today's loss, go back in time, usually 2 years, and apply it to a year you were profitable.
And get an actual refund. Cash back from taxes you'd already paid. For a startup that finally hit its stride, that was a huge deal. A real lifeline.
It's a vital cash injection.
Yeah.
But that lifeline, well, it mostly got cut.
Right. The Tax Cuts and Jobs Act of 2017, the TCJA.
The TCJA. For almost everyone, for tax years starting after 2017, that carryback option was just gone, eliminated.
So no more quick refund, which means NOL management suddenly shifted from a simple recovery tool to a much more strategic, long-term forecasting job.
Exactly. The whole focus pivoted from the past to the future, to the carry forward.
Which is just what it sounds like. You carry the loss forward to offset profits in future years. Now, the TCJA did make one change that sounds pretty good on the surface.
You mean making it indefinite?
Yeah, that. The old 20-year limit is gone. You can carry that loss forward forever, theoretically, but, there's always a catch.
There's a huge catch. And this is the part everyone needs to understand. It's the limitation.
The 80% cap.
The 80% cap. It's the strategic handcuff of the TCJA. You can carry that loss forward indefinitely, but you can only use it to offset up to 80% of your taxable income in a future year.
Okay, so let's make that real. Say your business has a $10 million loss banked. Then next year, you have a great year, you make $1 million in profit.
Right. In the old days, you might have wiped that all out. Now you can only shelter $800,000 of that income. You are still paying tax on the other $200,000.
The government guarantees it gets a piece, always.
No matter how big your past loss was.
That 80% cap, that's the real aha moment here. It means CFOs have to be way more conservative with cash flow planning. It even changes things like M&A, right? I mean, if you're acquiring a company with huge NOLs.
It absolutely diminishes the value of that asset.
Yeah.
You can't count on cashing it in immediately to shelter all your income. The utility is capped.
So for you, the business owner listening, with losses you're now carrying indefinitely, what's the one essential action step here?
Meticulous record keeping. I can't stress this enough. You might be defending a deduction from, 10 or 15 years ago in an audit.
And when you say meticulous, you mean more than just sticking the tax forms in a folder.
Oh, much more. You need the documentation that ties the specific deductions and expenses to the year you incurred the loss. Because if an auditor asks for it a decade from now, I don't know isn't a good answer.
And this isn't static either. The laws keep shifting.
Not at all. We saw the 80% limit get temporarily suspended during the CARES Act. It shows that lawmakers are still fiddling with these rules. You can't just set it and forget it. You really need professional tax advice and annual review.
So to wrap this up, the big takeaway is that understanding these NOL rules, especially the indefinite carry forward and that hard 80% limit, is absolutely crucial.
It's the key to maximizing your tax relief in this new framework.
But the success of your NOL strategy now really depends entirely on long-term planning, which leaves me with a final thought for you to chew on. Since that immediate safety net, the quick refund, is gone, and it's been replaced by this capped long-term IOU from the government, how does that fundamentally change the way a business should think about risk and investment today?
Well, folks, that's a wrap. Thanks for joining us for another episode of Tax and Accounting Ride Along, courtesy of Sands Virtual Enterprise, LLC. Got feedback or curious questions? Or maybe a topic that needs some airtime? We'd love to hear from you. Connect with us at admin@sve-accountingandtaxes.com or text us at 404-5858513. Also, follow us on Facebook, Instagram, TikTok, YouTube, and LinkedIn for more insights. Catch you next time for more business talks and good times.